Welcome to Power Lunch. I'm Kelly Evans, joined by Brian Sullivan, and we are just about 4 minutes away from the Fed's decision on interest rates today. No change in rates is expected, but it'll be very interesting to see what Chair Powell and the committee say about the current economy. Before we get to our panel, let's get a quick status check on the markets. Dow's off the highs from an hour or so ago, but it's up 0.5% today. S&P's up 2 points, so just about unchanged. The Nasdaq is down 0.4% as Alphabet is a big decliner today. It's having its worst day in a year and a half after an Apple executive said in-browser searches fell in April for the first time. This was part of their antitrust trial. It's taking Alphabet shares down nearly 8%. Apple's down a little bit less than 2%. So those are some big comments roiling the tech world today. Let's get right to our all-star panel as we're moments away from hearing from the Fed. David Kelly of J.P. Morgan Asset Management is with us, Stephanie Roth of Wolfe Research, and Jim Karen of Morgan Stanley Investment Management. David, first to you, and I failed to ask, not to get super wonky right off the bat here, but the balance sheet, right? I mean, that could be in play amongst many other things this afternoon.
Well, yeah, I mean, they're bringing down the balance sheet very slowly. But I think the most important issue that Chair Powell is going to have to get across here is he does not want to make a move on rates until he has got clarity on tariff policy and tax policy. There's a certain moral hazard involved if you cut rates and give an insurance policy to the other side of Washington. And I think he wants to avoid doing that. So he's going to try and find reasons to stall making any decision at all here.
Stephanie, what do you expect?
Yeah, I think that's right. He's not going to be able to preempt any sort of cuts, especially because the data that we've gotten recently have been pretty solid. So it certainly doesn't give them any sort of room to allude to that. We're going to be looking for indications about how are they thinking about if we have a slowing labor market but not a rise in the unemployment rate. What do they do from there? That's a really challenging backdrop for the Fed in an environment that's really quite uncertain.
Jim, we just heard Greg Ipps sort of saying, and when he read Powell's comments in his speech a few weeks ago, he sees him as almost erring on the inflation side of the mandate when push comes to shove. And the market is more or less bracing, I think you could say, for a hawkish hold today. How are you? What are you expecting? And do you think that's correct?
Yeah, look, I would disagree a little bit with Greg Ip on this. I think that he would be more erring on the side of the unemployment rate. I think the unemployment rate is going to give the Fed more high-level information in terms of what they want to do. I think inflation is staying stubbornly high, so I don't think the Fed is in a position right now to really try to counter that at this current juncture, but they will react to the unemployment rate. Look, there's one piece of good news here. The Fed does not have a dot plot at this meeting. They do not have to go on record and make a forecast. So I think that gives them some breathing room to at least start to think about, how they may backpedal a little bit here. I don't think they're going to move today. It doesn't look like June would be on the table at this point either. And I think the Fed's going to try to make it clear that they're just going to still wait and see how both, as David Kelly pointed out, both tax and tariff policies play out.
Brian, jump in here.
Yeah, hey guys, from out west at the Milken Global Conference. Good to see everybody. Listen, maybe I'll take a different tack, but everybody I'm talking to here the last couple of days, a lot of heavy hitters, the bond market, finance, et cetera, they're talking less about sort of the things that we're talking about, unemployment rate, inflation. They're talking more about Jay Powell. What does this say about Jay Powell, the human being? Does he react to the seeming political pressure of Trump? Powell, as a person, is also, I think, greatly in focus today.
I think that's a great point. And of course, we can't pretend like the Fed's making this decision, in a vacuum. They're making it up against some serious pressure from the president. So how that factors into things, we're about to find out. Let's get to Steve Leisman for the Fed's decision on interest rates.
The Federal Reserve keeping interest rates unchanged at 4.25% to 4.5%. But seeing a higher chance of stagflation. They didn't use that word, but here's the language they did use. They said the risk of higher inflation and higher unemployment have risen, both of those together in the same sentence. They went on to say a further increase in uncertainty. There's a further increase in uncertainty around the outlook, adding that word further to the prior statement. Also noting that swings in exports have affected the data. That's why we got to that big negative GDP number, and they took note of that for the first quarter. But saying economic activity still continued at a solid pace. The unemployment rate is stabilized at a low level, and that inflation remains somewhat elevated. So all of that basically in line with our understanding of the hard data. They say they are watching risks on both sides of the mandate. The decision was indeed unanimous. Quantitative tightening will continue, and the committee is prepared to adjust monetary policy as appropriate, which is a language that they've used in other times. Guys, this notion of the risk of both higher inflation and higher unemployment have risen. It really underscores that idea of there being risks to both sides of the mandate, and the Fed apparently being no closer to figure out which one needs more careful attention from the Fed yet. Kelly?
Steve, thank you very much. Steve Leisman is at the Fed. Stick around, though. Let's get some reaction from our panel. And I'll kind of go in reverse order from what we just heard. Jim, here you hear it, the stagflation.
Yeah, so the unemployment rate came up, right? So I think this is something that is somewhat, I wouldn't say new. I mean, inflation is not new. Inflation, we know, has been stubbornly high. But now that the Fed is starting to really comment on the unemployment rate, this is really the key. So look, everybody looks for the quote unquote Fed put in the markets. I think the Fed put is probably struck around a 4.5% unemployment rate, or at least a movement towards that level. So unless we get a significant deterioration in the labor market, then it's hard to have a deterioration in the overall broader economy because, you know, consumption is 70% of GDP, and that comes from labor. People have wages to spend. So ultimately what I think is happening here is that the Fed is really waiting to see if corporations in these earnings calls are going to start to now lay off workers as a result of this. If they don't see that and the labor markets stay relatively resilient, then we may be kicking the can down the road on rate cuts for a while longer. But we have to wait and see, and that's the point.
Yeah, the market's initial.
What is going on, guys? Didn't get a chance to welcome you. What's going on? Good afternoon. So I don't think anybody was confused about whether the Fed would raise or would cut rates or keep them where they are. I think anyone that knew anything that knows anything about the market knows that the Fed was going to keep rates where they are. That wasn't the big that really wasn't the big reveal there. They made a statement saying that they're going to continue quantitative tightening. So that is a fancy word meaning they're going to let assets roll off the balance sheet and not buy treasuries. And if you guys are keeping in line with my videos or with the news, you'll know that rates have been stubborn, sitting at around 4.3 for the 10-year, and then for the 30-year sitting at almost 4.8%. So they said that they're going to not do quantitative easing, and they're going to keep on with quantitative tightening. So they're not going to help the government at this time with trying to lower yields in any form, not by cutting rates, which I think everybody knew if you knew what you were doing, or by quantitative easing, which that was the one question on. So I'll be very curious to see how Jerome Powell frames this. And then, yeah, Sean O'Sullivan says, you look ill. Yes, ill because your mom won't leave my house. No, dumb shit. I just came back from the gym and I hopped on live for you. So I did not have a chance to coif my hair and do all the fancy things that your mom likes. Fucking dumbass, man. You wonder why there's so many losers in trading? It's because they focus on everything else except for the effort that it requires to be a good trader or a good investor, right? Like imagine being a man named Sean O'Sullivan and thinking that it's the highlight of your day to hop on a stream where someone is trying to cover a very important financial news driver for you and also tell you how to trade it and potentially take live day trades. And this cuck, Sean O'Sullivan, his only thought in his mind is, wow, he really looks like a little bit disheveled. He's not to my liking. Like, imagine being that kind of a cuck. I don't know. I'll never understand it. But we have we have Jerome Powell coming up at 2:30. So I obviously have a hedge that I've talked about on the market that expires at the end of the month. Not for today. I'm not trying to bet on what happens today. What I'm trying to do today is see if we get, when Powell starts talking, get a manipulative move and then fade that move. But overall, if you guys watch my channel, you know where I stand with regards to the market, right? I told you that I thought we would see some major resistance in this 5,700 area on the S&P 500, right around the tariff, the Liberation Day high. We have this huge area of consolidation here. If we go to SPX real quick and pull up the moving averages, right? We're sitting right on the 300-day, the 50. Now we have a second death cross now between the 50 and the 300-day. So I don't expect just from the back and forth from the White House, tariffs are on or off again. I don't expect that to take us down to 4,800. But I do think that if we start seeing material changes on the ground, such as shelves not being stocked up as much, or the worst case scenario is stagflation, where prices go up because there's a limited supply and the economy slows down, I think that kind of thing will take us down below 4,800. But I don't think this announcement, we have China talks. No, we don't. China, another 10% on China. No, we're taking them off. Like, I don't think that back and forth is going to take us down to 4,800. But for sure, I do think that we do see, especially if we close below the 300-day moving average today. If we close below that, then I think we go down to this new day opening gap between April 22nd and April 23rd, right? And if you look at the 4-hour on ES or NQ, which I like the futures charts a little better because they're more contiguous, right? You have the equal lows there, which I think will get taken out at least. And then that new day opening gap is right there. So I think that will get taken out at least. And then potentially between 53.30 and 53.80 on ES, potentially that area too. Not today, I mean over the coming days, right? So that is why I stressed to you guys that this was a high area of resistance, and we've already seen now, if we close red today, 3 red days in a row. Certainly we could get a manipulative move up when Powell starts talking, which is very likely. So I'm not, banking on today's move sticking, especially since we took out a lot of liquidity here. You could see this low that we took out, right? We could get a spring back up for sure. So I'm looking to see whether we get a manipulative move up and whether that can be faded either the same day or the coming days, right? This also looks like a power of 3. We had consolidation, manipulation into that fair value gap, distribution down to that high time frame liquidity area, which are these equal lows here, right? So we did sweep that, and I think NQ swept it as well. Yeah. Eventually, I think we get down to those equal lows on the 4-hour. So we'll see what happens with Jerome Powell today. But I'm very curious to hear his answers on the questions of quantitative tightening, quantitative easing, quantitative tightening, because their statement seemed very definitive, right? They said we are not going to do any quantitative easing. I wonder if I can catch a trade to Let's see. Wonder if I can get a long on NQ here. I want to see if we can get a long on NQ here.
Thanks as always for joining us. Bob Pisani's down at the New York Stock Exchange for his swan song Fed reaction here, Bob. And now we can throw some of these headlines into the mix.
Yeah, and the initial reaction was really rather muted, and then we got the China headline, so that really, I think, changed things a little bit. We were basically flat,
new headline,
a little bit negative. This statement is an exercise in preparing for several outcomes. I agree with Steve. It sort of sounds stagflationary, but he's looking on both sides of this thing. When I talked to people the last 2 days, most people down here are more worried about growth than inflation. They're worried about drying up the tourist business or inventory drawdowns. The problem is the hard data doesn't really support it yet, and that's really the issue. I know a lot of people out there, want the Fed to move, and we expect the economy to move as fast as we've seen the stock market move in April. But everybody knows that doesn't happen. The real economy doesn't move that quickly, and that's part of the problem. We just don't have the data yet. So a lot of people down here are dovish. They want the Fed to be preemptive. They want the Fed to do something. The data's not there. And the other problem is the Fed's inflation-fighting credibility has been severely eroded. Remember that whole issue, of course, what happened with inflation is transitory mantra of a few years ago. That really hurt their credibility. They're going to have to be very careful here about cutting preemptorily and then turning out to be embarrassed like they were a couple of years ago. So, again, the doves are looking for some signs. We're moving toward a rate cut. I don't think you have a lot of support here. Powell's going to have to at least show some data that confirms expectations of a rate cut. Otherwise, if he can't, they're just going to have to say what they're saying right here. They have to be attentive. The committee is attentive to the risk to both sides of its dual mandate, and that's really what you're going to have to take away from this right now, guys.
Bob Pisani, as always, my man, you nailed it. We're going to go to Rick in a second, but I want to come back to you, Bob, because I think the point I was trying to make with Steve was not what's right or what's wrong, not for me to say I have no idea, but this idea that the Federal Reserve's credibility, for good or ill, and not everybody would agree, I get it, but I can tell you there are people here that will say, the Fed screwed up during COVID, left rates too low for too long, then they kind of overreacted. You just said it. That inflation-fighting credibility is, let's be clear, I think it's taken a bit of a hit, and I don't know if the market is listening to the Fed as much as it used to.
I would agree. So here's the problem. There's two hurdles the doves have to overcome. The first is the data hurdle. The strong data of a clear downturn, the hard data, is not yet there. And the second is what you and I were just talking about. The Fed's inflation-fighting credibility has been severely eroded, and I think they're going to be very attentive to that. This is going to be an old story by Friday. Steve will confirm this. I think there's 8 or 9 Fed officials speaking on Friday, and they're all going to have individual opinions on this. So we're going to have a very, very broad range of opinions very, very soon in the next couple of days. That's going to help us get a better sense of where the Fed is right now. But the data's still not there.
Bob, thank you. Now let's go to Chicago and Rick Santelli, who can comment on everything we just talked about. And I will also add this, that despite all the ups and downs of inflation, rates, whatever it may be, here's the bizarre point. I know it's moved. The 10-year bond yield is at 4.2, whatever it is. That's the same price it was 2.5 years ago. Yes, it's fluctuated, Rick, but bizarrely, over 2.5 years, 30-plus months, the 10-year yield is exactly where it was before all of this. Comment on that, the Fed decision, or I should say, Fed non-decision.
Well, you know what? You hit on so many key issues. That 10-year rate and the relationship it has with mortgages, and this notion that, are we ever going to get under a 6.5%, 6.6% 30-year fixed mortgage. These are huge issues. And Bob hit something so important, and it's just so obvious. If you look at the data that, of course, put us at minus 0.3% on GDP, what that tells you is that there's not going to be any real trusting data for a long time. The pull forward, that's going to have a distortion. When we actually get more certainty on tariffs, we're going to have a landscape where inventories are going to be okay for a while. So you're not going to get an accurate read on the economy, which means that the Fed doesn't really have any better information than any of our viewers have. And I don't mean that in a negative way. Also, when it comes to credibility, the Fed got dinged in another area that nobody really seems to talk about, doing a 50 basis point cut so close to that election. I can't tell you how many people and sources always bring that topic up in context of what you brought up, Brian, that when you look at everything going on today, what will be the trigger for a rate cut? Considering all the moving parts. And finally, maybe the most important thing is look at 2-year, look at 10-year, look at the dollar, okay? We're making new low yields in a small way because equity volatility is really taking center stage, and the dollar index has been steady as she goes. Final statistic, these Fed fund futures prices right now are actually a little bit higher than they were at the last Fed meeting, which means that we still have a lot of easing built in, over 3. And the market is counting on it, even though the Fed doesn't want to promise it's going to deliver.
So not that hawkish, in other words. Rick, thanks very much. Rick Santelli. We're just a few minutes away from the chair's press conference. It starts at 2:30 Eastern. We'll take you there live as soon as it happens. But first, we'll hear once again from Claudia Sahm, and we'll take a quick break.
All right, so we have SMT at the lows. I think we get a CISD here. I'm looking for potential longs just to get to maybe OTE. Again, I'm just looking for a manipulative move. It's not, I don't think that this is, I don't think what the Fed said was by any means bullish. And then we are waiting for Powell in 10 minutes. So I'm just waiting to see if we can get a change in the state of delivery here to take a long. With the target on NQ to about 19.8. All right. That's a very nice push so far. I want to see if we can get to 19.8, guys. Stop is at break even. I'm just going to let it ride. We do have a big fair value gap there, but I want to see if we can push up to at least OTE. All right. I broke even on that one. Still up 600 on the day. I wanted to see if we can get a nice momentum push before Powell takes the mic in 8 minutes. We did get a little bit of momentum up. Could have obviously booked another 600 or whatever, but I wanted a bigger move. So at this point, I'm going to wait for Powell, and then take a move there. I wonder if this 1 minute fair value gap is worth playing. Haven't seen Thinkorswim in years. I trade on Thinkorswim every day. Just dump it. We already did dump. I think the manipulative moves to the upside. But I think it will eventually dump. Good news coming soon? I don't think this is good news, no. My high for the fib was right here, from here to here. Jerome Powell needs to be fired. Why are you using 10 minutes delay? Look at this fucking idiot. People just want to comment on stuff. Bro, I'm not using 10 minutes delay. Why do you guys just want to say stuff? Why? You look hungover? Actually, I was at the gym. So it's amazing that that's where your mind went. Because you don't know what a productive life looks like. I literally just walked in the door from the gym. But yes, of course, in your household, you would think hungover. All right, we're about 6 minutes from Uncle Jerome, guys. I want to hear what he has to say about two things: a June cut and quantitative easing. I would tackle you in the gym. Some of your guys are weird, bro. If I talk like that to another man, my dad would really question me. You notice that no females leave comments like that, right? It's just the guys. Why is your hair like that, bro? I'm gonna tackle you in the gym, bro. The fuck is wrong with y'all? You notice that women don't leave comments like that, right? It's just you fucking weird fuckboys. Bunch of weirdos. All right. NQ, don't go before Powell starts talking. I think we get up there when Powell starts talking. We took a major area of liquidity. We took that low from the beginning of May. This is actually May's low on NQ future. So we took monthly low. That's a major area. That's why I was looking for longs. I guess I shouldn't have broke even, but I think that was a good trade. After that SMT formed and CISD, yeah, maybe I should have stayed in the trade. We'll find another one. Hindsight Henry. Had a fire ass trade in the stream this morning. Took a short on NQ. Was in a long here. Ended up getting broke even at that wick right there. Oh well, it was the right bias. I think NQ goes to at least 19.8. Fed in 1 minute, guys. Let's listen in.
Hey.
What's your take on all the trade stuff, Mike? I mean, if you had to rank them in order of importance right now, would it be tariffs? Where does the tax bill fall? Then you have the Fed decision today, and maybe that's top level. Maybe the chair will say something that makes it top level.
Yeah, I think it is tariffs, for better or worse, even though trade itself is not the big swing factor for this economy. You know, we have a $1 trillion trade deficit on a $30 trillion economy. On the other hand, it's the biggest range of possibilities there in terms of a stagflationary shock or nothing at all or something very manageable. So I think incremental moves that seem substantive on de-escalation. I think some measure of de-escalation from here is largely priced in to the stock market. So that's why I think we're tracking it. It doesn't make sense in a $50 trillion stock market. Twitches on every one of these headlines, but it's kind of all we have to work with in the short term.
Yeah, I would say things are twitchy. And by the way, we got to go to Powell, but tomorrow we'll be live, Kelly, Port of Long Beach. Firsthand, real-world look at the ships, the cargo, the tonnage, what's important now, and more importantly, what's coming. That'll be tomorrow. Exclusive data. Should be very insightful, I think.
We should stage a permanent camera there to count the ship activity and try to get a sense of what's going on in this economy.
You know, that's a pretty good idea, actually. Have like a YouTube. We're going to go to Jay Powell right now in Washington, D.C.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last...
I knew we'd get to 19.8, man. Fuck.
The bill advancing in Congress, and I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think, if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 as the flag shocks. But there are some who argue that the current situation has notable differences. Energy costs are down. Housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling, with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each with each week and month that goes by, where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times, but the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now, and we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. we would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time. So, again, difficult judgment to make, and not one that we face today, and we may never face it, but you know, we have to be keeping it in our thinking now.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. you mentioned it yourself, that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in the actual economic data yet. And by the way, consumers keep spending, credit card spending. It's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still.
All right, so we got the initial move up. That long that I was in earlier, yeah, would have paid very nicely. Got out for break even there. Haven't yet taken another trade here. So we had the move up. Like I said, we were going to get a manipulative move, and I want to see if we can fade that move back down. But I need to be sure that this is the extent of the move up. And I don't know if we could tap that high after 2 p.m. there first. Which is definitely a possibility. So I'm looking to see if after taking that 230 low, which was the data low, I don't know if we have enough to get up there. Thought we might cut rates. No. I don't know why you would think that. But the Fed basically said that, you know, this is a very hawkish Fed here, saying that there's so much uncertainty about tariffs and that they really can't do anything without there being more certainty on that front. And they're not doing quantitative tightening. I mean, easing. Yeah, that would have been the fucking trade of the day, to be honest. I had a long from here. I had a long from here. Oh, well, there it is. And guess who took that high? I wonder if we can fade this move back down. Man, I should have stayed in that goddamn long. I think we're going to these equal highs here. NQ. Oh, we have slightly different profiles here. I'm looking to see if there's divergence between NQ and ES here. I think NQ or ES can take that high while NQ doesn't, or vice versa. Why no re-entry on the 5-minute inverse? Look at that candle. You're going to re-enter this for 3 points? Oh man, that long was amazing. That long was amazing. Do you play video games? This is my video game. All right, so we took that high on ES, NQ didn't. I love it. I love all the hindsight trackers. Should have stayed in. Yeah, and your mom should have married Brad Pitt, but she didn't. All right, let's see if we have divergence here. But don't make a mistake. Don't be mistaken about it. This is the most hawkish the Fed can sound. Like no quantitative easing. Didn't cut rates. Didn't say that they would cut rates in the future. Said that there is mass uncertainty with tariffs. We're not in a situation where we can be preemptive, etc. Right? So not even an ounce of dovishness. He's been sounding like this. Well, this is the first time that they talk after the updates with the tariffs. I was looking to see if they cut rates. Then you have no idea what you're looking for. There's no way they would cut rates. The question was, would they do quantitative easing or not? Yeah, I do think that there is a short coming up for sure. We got the divergence there. ES is weak compared to NQ, the other way around. Is that the high for the day? Or do we want that high? That's the question right now. So if I can get that's the only question right now that's stopping me from taking a short. Is this the high of the, is this the sweep, or is the sweep going to be up here? In which case we rally more. This is where we start going to confirmations. That right there is a bullish breaker. So I would need confirmation that we're not just going to bounce off that breaker to take the other high up top. See, This is why the optimal play is the one that you should stay in. And I'm writing that note to myself. I really had the optimal long from down here. Mierda.
Thanks.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
I agree with you, MK. There isn't a setup here to force, to be honest. There is not a setup to force, to be honest. Yeah. I could have extracted way more money out of this for sure. For sure. These are moments your experience shines. Composure after missing a trade. Oh yeah. I'm over the trying to click away at a revenge. I do think we're going higher to take out this high if I had to put my money on it. We take out this high. There's that fair value gap up here on NQ. But I can't take such a small trade like that with a wide stop limit. I was down 500 today, only down $10. Oh, good. I called it, but unfortunately, I also got broken even. So yeah, I did think we would trickle up, and then fade the move. But over the course of the long term, I do think we get to 19.1 on NQ at least, and 54.50 on ES at least within the coming days. This is the most hawkish the Fed could have sounded. I wonder how the market will react on Thursday, Friday, Monday. It might be brutal. And usually after the release of a Fed announcement, we get VIX crush, right? Because the supposedly the biggest news is over, the VIX is still trading at 24.5. It did not get crushed a lot today, right? Like we didn't see a move like this. So something tells me that the market the market is still yet to digest this with quite a bit of volatility. Oh, you banked on NQ? Hell yeah. Good job. Wall Street likes animals? Yeah, for sure. I think we consolidate for the rest of the day until Jerome Powell leaves the podium. When Jerome Powell leaves the podium, you'll see a big move, and then tomorrow for sure you'll see a big move. The market has just gotten used to it. No, dude, this is how FOMC always is. And if the market got used to it, the VIX wouldn't be at 24. I wonder. You're in a short? That's brutal from here, bro. Someone was asking about Google. So with regards to Google, it's still in this consolidation range. Yes, one day 7.5% is a big day, but we're still in this range. So the news was that Apple came out and said that they might be basically bypassing the browser search, because on Safari, when you search like on your iPhone and you search in Safari, that defaults to Google search, right? So Apple said today that they're mulling taking that away. But I don't think that's a big deal because we already knew Apple Intelligence was coming up. And ChatGPT is already baked into Siri like right now. So to me, that is just an overreaction. Plus 80% of the world uses Android. About half of the country uses Android. So, I don't think it's that big of a deal to tank 7.5%. I do like Google at this price for sure, but this is around the price that I bought it. So I'm not looking to add more here. I already added a good chunk in the 140s. If you don't have Google, sure, you could buy it here. But I definitely think this is an overreaction. We already knew that Apple Intelligence was coming. That to me is not a big news driver. Apple Intelligence sucks. Yeah, now, but obviously it's not going to. Get on this trade. I don't think your short is good here.
But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And right now we see inflation kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night. And this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance.
Why NQ and not NDX? What? Why the hell would I trade NDX? Oh, noob? Okay, that makes sense. You can't trade NDX. You can only trade NDX options. And NDX options have horrible bid-ask spreads. So NQ futures is where it's at. Oh, man. All right, guys. Well, nice idea in the beginning. Called the move. Too bad I was broken even on the trade. Would have been like $1,500 per contract, but oh well. I'm up a measly 600 across accounts. I don't know. Not the day that I was envisioning, but better than being down. So yeah, I will catch you guys on the next YouTube video. For those of you in the Discord, I'll see you in the Discord live market open tomorrow. We do it all over. And if you want to trade live with me every day, link is in the description. I appreciate you guys. I'll see you guys in a bit.